Hi, and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I am joined by Tim Sustak, our SVP Chief Treasury Officer for Vizo Financial, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. Scott, I'm going to kick things off with you. So the last time we met, uncertainty was the word you used a lot. So has uncertainty, is it still the word you're using? Are we still, feeling the effects, is that the word you're still using to talk about the current environment?
Yes, I think uncertainty is still I don't want to call it our friend because it's really not our friend, but uncertainty is the word of the day and the word of the month. I gave a presentation recently, and one of the folks in the audience said maybe I should call it year of chaos. And I was like, you know what? Chaos could work too. But certainly a lot of uncertainty. So I think there has been some progress made, some progress, minor, but we're heading in a different direction. When Trump first made his tariff announcements, there was a ton of uncertainty. It wasn't before then we had this uncertainty. Trump came out and made these tariff announcements, and they were not what the market was looking for. It was one economist said it was, basically the worst case scenario that anybody could have had, and it just was unexpected. So you saw the market's reaction were not very positive at all. Markets don't like uncertainty, so he gave us a bit of certainty by saying these are the levels, but we have all this uncertainty because we know it's a negotiation tactic in a lot of cases. So it's really not certainty, and we've seen this, right? We've seen this since the tariffs came out. Initially, these were on there. The markets were not doing well. The equity markets were not doing well, but the bond markets initially were, down, but they were functioning properly. But then we reached the point where maybe the fixed income markets were starting to function abnormally also. Scott Bessent, the Treasury Secretary, I think had maybe spoke with Trump from what I've read. They had some discussions anyway, that was not a good thing, right, for the economy or for the market. So if you remember after that, there was that kind of freeze on tariffs, on certain tariffs, the country-specific tariffs, except for China. So China now has 145% tariffs. Every other country is 10% across the board. Auto tariffs from imports are 25%. So a little more certainty. They're working on some trade negotiations. I feel like we're making some progress. Again, Scott Bessent seems to be the guy that's leading the charge here. Well respected by Wall Street. So he's the guy you want making those decisions or making those, in those negotiations. So he's been a prominent face here over the last couple of weeks. And I think that's introduced a little more certainty to the markets. There's still a lot to be to be figured out and for us to know. So there's still a lot of uncertainty out there, but I feel like there's been some progress made in a positive direction. But again, people are still uncertain. So companies, when they're uncertain, what do? They kind of hold back on projects. There might have been a project they announced and they're like, you know what? We're going to pull this back right now. We're in kind of the middle of earnings season. A lot of companies are saying we can't even give you a projection right now for the next quarter or next 2 quarters because there's so much uncertainty. So it's starting to come into companies' decision making and then ability to predict how their quarter is going to go. So still a lot of it out there, but I think we have made some strides, baby steps, a couple baby steps along the way.
All right. Well, thank you. So, Tim, I have to ask, do you agree with Scott's assessment? Is there anything else you'd like to add?
No, I would say I do agree with Scott's assessment wholeheartedly, and I'm uncertain if there's anything that I could add to make it any more clear. So I think I'm just not even going to try.
Okay. All right. Well, one of the things that, it's kind of come up in conversation, it kind of makes me chuckle is depending on who gives the announcement will determine what actually happens to the market. So people are always looking for a very certain person to be the one who's the spokesperson of the day. So I always find that comical.
Yeah.
All right. So Scott, let's talk unemployment. What happened? What's happening with unemployment rates and the job market?
So the job market, if you look at the data, which we get the unemployment rate, and the number of new jobs created. We get that the first Friday of every month. When you look at that data, it's been very solid and strong, in what you would consider a well-functioning economy. So, we've heard a lot about those job cuts, but we haven't seen that really hit the data yet. And there's could be a number of reasons for that. One of the prominent ones, I think, is the fact that a lot of this is still being litigated. So we don't know if, some people have lost their jobs, but a lot of the folks that were given notice that they're losing their jobs, they're still getting paid. So as long as they're getting paid, then there's going to be a delay before that hits the actual data. So we have seen some jobless claims coming, slight increases in the Maryland, DC, Virginia area that are, DC centric people that work in that area. So there was a little initial uptick, and it's kind of since abated, or mostly. But as far as the national data, it really hasn't filtered through yet. So for the last 4 or 5 months, our unemployment rate in this country has been 4 to 4.2%. Right now, the latest reading was 4.2%, 2 or 3 weeks ago. So in a normal function economy, we generally say 4.5% is the normal rate of unemployment, and we're below that still. So that's still strong. In March, the markets were expecting that we would have 120,000 new jobs created. Well, we had 228,000 jobs created in March, so that was a big beat on the job creation front. A lot of new companies are still being formed out there. They're a big employer, as not individually, but as a group. Small employers make up the lion's share of employment in this country. So the creation of new companies is a net positive too. So the JOLTS job report, which looks at job openings, it's still in that $7 million range, not dollar, but 7 million people are openings. So that's still very strong. So there's really a lot of really strong data on the on the employment side. Initial jobless claims have remained relatively stable. We're in that a little over 200 to 240, let's call it, 200,000 to 240,000 a week filing new claims. That's pretty normal. And continuing claims, the same thing. It's gone up a little bit, but it's still in a very positive area. So all of these areas have been strong still and still looking good, but it's going to bear keeping an eye on over the next 2 to 3 months and seeing if we see these numbers, if the unemployment rate starts to tick up or if the jobless claims start to increase on a weekly basis. Those are areas to kind of pay attention to.
Okay. All right. Well, homes is something, that's important as far as mortgages and things like that in the credit union industry. Tim, what are you seeing in the housing market, and what impact will it have on the credit unions?
Yeah, so I think, we start out with rates here. Obviously, we've seen volatility there. Somewhat volatile in the mortgage market. Obviously, also, I think last week rates spiked up to 7%. Now, starting this week, we're down to about 6.7 starting out. Generally follow 10-year treasury. So as long as we continue to see some volatility there, we'll continue to see a bit of volatility in mortgage rates. One of the interesting things that I've read from a few of the market makers out there is, although we're seeing this kind of short-term up and down in volatility over the past few months, that volatility has been in a range, I think, of about 20 to 30 basis points, somewhere around there. So although we're seeing these moves in a general sense over time, there's still some stability there, albeit rates staying at a higher level than maybe what we would have expected towards the end of last year, very beginning of this year, when we thought maybe the Fed was still gonna cut more here in the beginning. So that's good in that it gives some stability to buyers and sellers. I think the data out there is still really mixed. You hear things like, hey, March new home sales, took off a bit, but then, through April, new applications and existing applications, had fallen off. So I think we'll continue to see that just as all these things play into the market. We still have, tariffs to work their way through on building costs. I think, for new homes, builders are trying to kind of right size that inventory to keep a control as much as they can on costs. Because I think, data has shown that people will certainly take them up on decent offers if they can get them as far as price. But I think, overall, higher rates will continue to persist because, this is something I'm sure we'll talk about here going forward. But I think any of us expect rates to drop anytime soon, at least from Fed action. You can read that home availability, is getting better, kind of in fits and starts, but I think overall still constrained. I mean, I think we would, versus what we would see as normal functioning housing market, you still see supply constrained, particularly because, like we had talked before in our podcast, nobody wants to give up a mortgage they got, 5 or so years ago for something that they can get today from a rate perspective, right? So you're just not seeing that churn. Um, it would seem that maybe HELOCs for credit unions are an easier make right now as people keep homes, they can do things there. Some of the data seem to suggest that. So that may be an avenue. I think mortgages, as you get the opportunity, I think you see rates fall a little bit, you get some uptake, things like that. But I think it's another one of those things that we just have to kind of wait and see how all these things work out.
All right. Well, Tim, what about the auto market? What are you seeing there?
Yeah, so the auto market is a little bit interesting because people have a chance to get out in front of the tariffs, right? And we've seen that. I mean, there's been a bit of a buying frenzy out there to try and get your car if you want it before the tariff price increases take hold. I was looking at some data, the advanced estimate for retail sales. I mean, cars, auto industry was the star of the show. Everything was fairly flat to down. The auto sector increased 5.3%. Cox Automotive came out talking about from a volume perspective, sales through mid-April, up 8% over the prior year. So people are getting out there and getting their automobiles, which is great, right? Because we know, as Scott mentioned, we have our 25% tariffs on autos right now. We're going to be getting the 25% tariff on imported parts starting May 3rd. So that's gonna add a little bit of pain to the process. Kind of referencing Cox again, their interest or their estimate for the increase in cost for an imported vehicle will be about $6,000 based on tariffs. But even for an assembled in the U.S. car, which we all know still has a lot of foreign parts in it, even though it's assembled in the USA, will still be up about $3.6 thousand, $3,600 once that tariff starts to take effect in May. So, people are trying to get it now before they feel the pain. I've seen estimates anywhere from 30 to 60 days maybe you have to get in on it before, those price hikes start coming. So, I think, the overall goal, right, is President Trump wants us to see us building more cars in America, right? And he's talked about a reprieve maybe on the 25% tariffs. Don't know for how long, but the issue that I read is, to move production here. I mean, there are some. I think Nissan is one where they said, "Hey, we have spare capacity. We can move things around and really help ourselves by utilizing that spare capacity to build more here." But if you don't have spare capacity, you need to bring production here. I mean, it's not a months long; it's a years long process to spin up a production plant, get the technology in place, get all the supply. Contracts and infrastructure done. It's a years long process. So it's difficult to think, that we kind of give a long enough reprieve to get people to do that. It would have to be an extended duration. So, I think make your auto loans now. It seems like things could slow up here a month or two down the line. So, Scott, I don't know if you have anything you want to add to that, but that's what I see out there.
Yeah, I mean, I agree. It's a crazy world, and as you mentioned, with more of this uncertainty stuff, that Trump may take some of these tariffs off for a period of time, but it certainly has front-loaded purchasing for a lot of folks that we're looking to buy.
Yeah. Well, Scott, every now and then we're still hearing words of recession. So, what are your thoughts on recession? Are we headed for a recession?
This is a tough question. Very tough. So a lot of Wall Street firms, economists have increased their likelihood of a recession, but for many of them, it's still under 50%. There were a couple, J.P. Morgan and I think Bank of America. There were a couple that kind of raised theirs above 60%, around 60 to 65, but then they since lowered, they lowered them down when the tariff reprieve was given, where a couple of weeks ago. But I think that's the issue is just all this uncertainty. It's really hard to know for sure. If I were to just give a hard yes or no today, I would say um, not super convincingly, but no, I don't think we're going to. I think cooler heads are going to prevail. But there's a lot of data out there that could certainly lead us down that recessionary road. And we've talked about some of the economic indicators today, the employment situation. We've talked, Tim talked about home sales and car sales,
Right.
which are, those things drive and rentals. They drive consumer spending, which is the big part of our economy. And that's generally if we see 2 quarters of negative GDP, while it may not be officially a recession called at that point in time, we're gonna start talking about it like that. That is a recession kind of thing. When you look at economist surveys right now, the median is not showing 2 consecutive quarters of negative growth. When you look at Bloomberg, they survey a bunch of different economists, but that's going to be the wild card. Do consumers continue to spend um, and keep the economy afloat? And do we see large job losses? And those are things that we hope we don't. If people start to lose their jobs, then the consumer may start to save a lot more money
Mhm.
just to prepare for a rainy day in case when your neighbor loses their job, you start to get worried, or somebody you're like, okay, are reading all these headlines? I could be next. I've given a few economic presentations here recently, and the thing that you're probably hearing a lot in the economic press is the hard data and the soft data. When you look at the hard data, the actual numbers of people that have lost their jobs and what is inflation and all these other things, that stuff is actually very positive right now. And again, some of that maybe hasn't filtered through yet, but it's all really strong positive data for the most part on the hard data. But when you look at the soft data, which is more like opinions or sentiment, like the New York Fed does a sentiment gauge, the University of Michigan does their consumer confidence, consumer sentiment used to be called consumer confidence. So they do these gauges, and when you look at those things have been very, very negative here recently. A lot of this soft data. What do you feel is going to happen in the next, 1 to 3 to 6 months or a year? That's been not very positive. When you ask people what are the chances they're going to lose their job, or they're going to not get a very strong pay raise, or just about the economy in general, or inflation, those are all really, really negative numbers. So the two pieces of data are contradictory right now. They're not matching up. And the fear is obviously that the soft data could bleed into the hard data and become reality. The Fed is focused really on the hard data right now. So they're going to make their decisions based on that. But if you look just at the hard data, you'd have a hard time making a case that a recession is imminent. But the soft data will give you pause and say, you know what, yeah, we may hit a recession here, but I think that cooler heads will prevail with tariffs and everything else. The consumer still looks really strong to me. Retail sales were at 1.2% last month. I flew today on the plane again, packed, packed, packed. I've flown a lot in the last 3 or 4 months. Every plane I've been on has been to capacity. Every restaurant when I go out to eat, full. I mean, busy. It's we're starting to see small signs that there might be a slowdown, but really, it hasn't really pushed through yet. I don't think people are still feeling okay enough to spend money. So I'd say no for now.
All right. Well, Tim, the Fed, they meet next week, obviously. What factors is the FOMC looking at prior to the meeting next week?
Well, there's a lot of good data coming out this week, Jamie, but unfortunately, with the Fed in their blackout period, they won't be able to discuss it with any of us. So we'll have to wait until the meeting to see what they think. But on the 29th on Tuesday, the 29th is Tuesday. Yeah, we have Conference Board Consumer Confidence coming out. We all know consumer confidence has been suffering a bit with all the uncertainty as we talk about going on. Based on the latest Michigan reading, it was down. Nobody expects this to be a great report, so the thought is consumer confidence will certainly continue to trend down. On the 30th, we have GDP and PCE both. GDP. Looking at very little growth in the first quarter. Consensus is about 0.2%. Probably no surprise there. But PCE, which is the Fed's preferred inflation gauge, consensus looks at to be flat month to month, maybe down a couple of tenths on a year-to-year basis. And we get an employment report on 5/2, which as Scott had mentioned, very important. Payroll is expected to be up 130,000. That still up but slowing, and an unemployment rate stable. So the Fed will be taking a look at all those metrics when they come out to see whether they're as expected or what that may mean. Other than that, nothing much happening, right? I mean, no, they'll obviously, like all of us, they'll be watching what's going on in the tariff game because as we talked about pretty much this whole podcast, that's a huge impact on everything. Yeah. Economic. So, they'll be sitting and grabbing their popcorn and watching like the rest of us. So,
all right. Well, Scott, what is going to happen at next week's meeting and why?
Yeah, I mean, the Fed's not going to, as far as making any rate moves, they're not going to do anything. They'll be sitting there at that meeting. When you look at Fed Fund futures, the markets are thinking it's going to be the July meeting, which is basically 2 meetings from there. So they'd skip the June meeting and then maybe go in July. Again, as Tim said, it's really centered around this uncertainty, and the Fed is going to focus on the hard data, which has been positive so far. So as far as rate changes, nothing at all. The Fed will do nothing. Now, they're probably going to tweak their statement a little bit. What Powell has been out a lot lately saying is they're going to be, and he said this at the last meeting too, they're going to be patient. They're going to sit and let the data come to them. And once the data starts to show signs of weakness, and this is the hard data we're talking about, the actual unemployment numbers or inflation or whatever. Mm-hmm. And by the way, inflation has made we'll see what PCE said, as Tim mentioned, but CPI, the last reading, there was a pretty good drop there. With the CPI inflation reading. So that's a positive thing for the Fed. It buys them a little more time. So as long as inflation continues to either hold steady or come down and the unemployment rate doesn't get crazy, then the Fed can they have plenty of time at that point. They can sit there and let things happen and not have to feel like they have to intervene. Obviously, if there's something crazy systematic that goes on in the system, the Fed will intervene. But we don't expect them to make any rate cuts at this meeting. Changes to their statement. We're aware of what's going on. We're going to continue to watch it. There's a lot of uncertainty. We've got time to wait, kind of thing is what I would expect.
All right. So Tim, I'm going to assume you agree with Scott's assessment. So any final thoughts for our listeners today?
Yeah, I absolutely agree with Scott's assessment. Final thoughts. I mean, it's hard to know what to say. I think, keep your head down and keep watching, because I think, although the healing of some of these things may not be fast, things can certainly change fast. So just stay tuned.
All right. Scott, any final thoughts?
No, I like Tim, stay tuned because as we've seen with the tariffs and everything that goes on there, things do change rapidly. I gave a presentation one morning, and 3 hours later, they put a pause on tariffs. So pretty much everything I had talked about from, that was out there had changed that rapidly. The markets are still digesting everything and trying to figure it out. The Fed's still trying to figure it out. So for us to have a chance, probably not, unless you're somebody on the front line that sees some of this stuff directly, and you can say, oh, there's definitely weakening coming or things like that. Yeah, stay tuned. Pay attention to the data and what the Fed has to say.
All right. Well, as always, thank you both so much for joining me today. Really appreciate your taking the time. This episode of Financial Minds is brought to you by Vizo Financial's Financial Conference. Save the date. The Corporate's Financial Conference will be held in Asheville, North Carolina, again this year at the Grove Park Inn, September 10th through the 12th. Look for more details in the coming weeks. As always, thanks for listening and make it a great day.